Good afternoon, everyone. Thank you for joining us for this session on housing trends in supply, affordability, and home prices. My name is Scott Weiner, and I am an economist at the Federal Housing Finance Agency. I'm honored and excited to moderate this session, so many thanks to the folks at Freddie Mac for organizing today's symposium and for inviting me to speak. I might as well say up front that any views I express today are my own and not those of us of FHFA, and that also holds for all of the presentations that will follow. In this session, we will have three very interesting presentations. First, we will have Peyton Whitney, a research analyst at the Harvard Joint Center for Housing Studies, presenting joint work with Alexander Herman on the geography of pandemic-era home price trends. Next, we will have Jessie Hickly, a senior economist at Freddie Mac, presenting her work entitled Navigating Affordability, Rural Insights and Opportunities in Home Ownership. And finally, we will hear from Adam Staveski, a principal associate at the Pew Charitable Trust, presenting his work on small mortgages as an opportunity to invest in rural communities. So, without further ado, let's get started. Peyton, the floor is yours.
Thank you, Scott, and big thanks to Freddie Mac for organizing this event and for the opportunity to share some of my work. Work for myself and my colleague Alexander Herman on the geography of pandemic-era home price trends and the implications for affordability. I will briefly offer some background on the project. The motivation for this work stemmed from the unprecedented rise in home prices following the start of the COVID-19 pandemic, precipitated by a few factors, including a record low interest rate environment, increased demand for space at home, and the aging of millennials into their peak home buying years. And this was met, of course, with a historically tight for-sale supply. And in this context, the proliferation of remote work opportunities accelerated migration trends away from larger, higher cost, denser markets toward lower density and less populous areas, which in turn disproportionately increased prices in traditionally more affordable markets. So these observations led us to our key research questions, the first of which is, where did home prices rise most rapidly during the pandemic, and how does this compare to pre-pandemic trends? We also wondered, did differences in the geography of home price growth persist into 2023 as the housing market cooled? And finally, we asked, what has the disparate rise in home prices meant for housing affordability in previously affordable market types? So to understand how home values changed over different types of geography and before and after the start of the pandemic, we did have to split counties according to the following geographic scheme. And we followed Jed Kolko's work to group counties by size and density. We first split counties into metro and non-metro counties, and then we split counties lying inside of large metro areas or metro areas with at least a population of 1 million into higher, moderate, and lower density county types, depending on their population density. Smaller metro counties were those falling within metro areas with a population of under 1 million, and non-metro counties encompassed all micropolitan and rural county types. So this map is just to give you an idea of where these county types lie across the country. You can see that most of the counties across the country are non-metro. They do make up about 60% of the counties in our sample, and they also contain just 14% of the country's total population. So the main data source that we used was the Zillow Home Value Index, and this provided typical home values over time at the county level. We supplemented this data set with the 5-year American Community Survey, which included demographic county level data such as the number of homeowners, population, income, etc. Methodologically, we estimated the average typical home value weighted by the number of homeowners by our geographic categories, our county types. And we similarly estimated an affordability measure called the average home value to income ratio to understand affordability conditions across our county types. And we think of this as an affordability measure for existing longtime residents, since we are using a static measure of income from the 5-year American Community Survey. A key data challenge that we dealt with was inconsistent coverage in home value data being reported by Zillow. So this is showing the share of population in counties that are reported by Zillow over time. And you see that especially for rural counties, this is a significant challenge that we needed to deal with. There are serious gaps in population coverage in earlier years of data, with significant increases in coverage in around 2012 and 2016. So to deal with this challenge, we needed to create 2 samples of counties to track home prices in the long term, which was our 2012 sample using data from 2012 on, and in the short term using data from 2017 on. In our 2012 sample, home value data is available for most metro counties, but only 85% of the population in non-metro counties. Non-metro county populations are more fully represented, though, in our 2017 sample, and we use this for much of our analysis. So just getting into the analysis and results from the project. Just to get a high-level look at the Zillow data, here's a graph showing the U.S. typical home value over time on the left axis and its growth depicted on the right axis. You can see home values grew quite steadily from 2012 through the start of the pandemic in 2020. Then home values skyrocketed across the country and peaked at 18% annual growth in August of 2021. Remarkably, in the 3 years between March of 2020 and 2023, U.S. typical home values grew by $88,000, which is almost as much as the $90,000 increase seen in the preceding 8-year period. Since income growth has not kept pace, what this works out to is widespread affordability challenges that end up pushing the prospect of home ownership out of reach for many households. Looking at more granular levels of geography, this pandemic-era trend plays out within counties across the country. This map depicts the percent change in typical home prices in a county between March of 2020 and March of 2023. Home prices in more than half of all counties in the country increased by between 30 and 40% in this time, and prices increased by 40% or more in nearly 1/3 of all counties. This is starkly different from the preceding 3-year period, in which home values increased by at least 30% in only 6% of all counties. Now, looking at a longer time horizon, we use our 2012 sample of counties and show the typical home value growth over time for our defined 5 county types. What you notice is that historically, home prices have grown at higher rates in counties within large metro areas. In 2019, this trend shifts significantly and then becomes more pronounced in mid-2020 as remote work flexibility during the pandemic allowed households in denser, more populous market types to purchase homes in more rural areas. And they were able to take advantage of the relative affordability in these market types. So next, we use our more geographically complete 2017 sample, and we analyze home price changes by county type over time, looking at 2 3-year periods, one from March 2017 to March 2020, and one from March 2020 to 2023. This graph shows the percent change in typical home price by our county types in those 2 time periods. In the first 3-year period, home values grew at relatively similar rates across all county types, you see by about 16 to 18%, but this shifts significantly in the later period, with home values growing the most in less dense and less populous areas. home values increased by a whopping 36% in lower density suburban, smaller metro, and non-metro county types. And by comparison, home values in moderate density counties increased by 30%, but in higher density urban county types, we saw home prices grow by just 21%. Breaking this out regionally, we calculated the typical home value growth by county type between March of 2020 and 2023. Clearly, the trend of home prices growing the most in non-metro counties is geographically widespread. You can see that county type leads in the highest amount of growth across all regions except for the South. Home values in the West and Northeast, however, increased especially quickly by 41% over this 3-year period, compared to 36% in the South and 32% in the Midwest. Next, we dove into the affordability conditions across our county types. Here, we're depicting the average value-to-income ratio by county type in 2017, 2020, and 2023. And please recall, in our analysis, this is best thought of as a measure of homebuyer affordability for existing long-time residents. In 2023, higher density urban counties did have the highest value-to-income ratio at 6.0, meaning on average, the area typical home value was 6 times that of the median household income. Value to income ratios have always been high in these county types, though, originally measuring around 4.2 in March of 2017. By comparison, affordability did deteriorate the fastest in least dense non-metro counties. Value to income ratios rose from 2.5 in 2017 to 3.9 in 2023. This is nearly as much as the value to income ratios estimated in the densest urban counties in the pre-pandemic period. And with much higher interest rates in 2023 than in 2020, this translates into even greater affordability challenges for existing residents. Again, breaking this analysis out regionally, we show home value to income ratios for non-metro counties specifically in 2017, 2020, and 2023. You see that affordability declined in the second 3-year period much more rapidly than in the first. In the West, home values were nearly 7 times the median income in non-metro counties, highlighting the widespread affordability challenges of this region. While this measure is far above that of other regions, home values still sat at least 3 multiples the median household income in the Northeast, the South, and the Midwest in 2023. To conclude a bit, I show here a snapshot of the average typical home value by our county types in 2017, 2020, and 2023. Home prices have risen the most in moderate density suburbs of large metros by around $100,000. And this is between 2020 and 2023, so the pandemic era. And they've risen by $60,000 in non-metro county types. So overall, home values remained highest in the higher density urban area counties, and lowest in non-metro counties, but across the board, home values are extremely elevated everywhere compared to 2020. More recently, we have seen home prices continue to grow across all county types, despite being elevated far above pre-pandemic levels. And there are still persistent favorable demand factors at play here. If this trend continues and home prices keep rising, particularly in a high interest rate environment, more and more longtime residents of rural areas will surely be priced out of homeownership and precluded from its vital economic opportunities. To extend our work, we do have 2 projects underway currently. The first will cover characteristics associated with rural home price growth during the pandemic, examining rural areas where home price growth was more rapid and documenting the characteristics of these areas. The other project will dive into rural migration trends since the pandemic, tracking domestic migration trends in rural areas and characterizing in-movers, specifically to areas with extremely high home price growth. And both projects should be important extensions to this work in understanding affordability implications for rural residents. Thank you. That's all I have, and I'll pass it off to Jessie.
Thank you, Peyton. Hi, everyone. My name is Jessie Hickly, and I'm a senior economist at Freddie Mac. Today, my topic is also on housing affordability, but with a focus on how we identify potential home buyers. So over the past few years, becoming a homeowner has become increasingly difficult, mainly due to the rising house prices and higher mortgage rates. In early 2021, the mortgage rate was below 3%, and now as of October 2024, they have climbed to over 6%. Meanwhile, the national median home value has increased by over $100,000, or about 38%. With some regions seeing even sharper increases than the other regions. And the shortage of housing supply has been a factor in this price surge. The issue was already chronic long before the pandemic, but it got even worse as many current homeowners locked in with the low interest rate has become reluctant to sell their houses. And this further limits housing supply and push house prices higher. Given the market condition, a key question is, who can still enter the market and how many potential home buyers remain? So in this presentation, I will walk you through how we combine various data sources to identify the potential home buyers and understand where opportunities might exist. So in these slides, we try to explain how we identify potential home buyers using what we call the building block methodology. We begin with the credit bureau data and focus on consumers in their prime home buying age. And following industry standard, we define this age range as 25 to 55. And this is our first building block. For the second building block, we analyze their credit characteristics, property ownership status, and mortgage history. We exclude individuals who have already owned a house by matching their names and addresses to the deed data. So we also try to filter out those who currently have a mortgage or have had one in the past 3 years, so that our focus is on the potential first-time home buyers. Next, we try to assess their credit worthiness. We look for individuals with a strong credit standing, specifically a Vantage score of at least 661, and we also exclude anyone with major negative credit events such as bankruptcies, foreclosures, or severe delinquencies. The third building blocks, we try to evaluate their affordability. We assess whether an individual, their income is sufficient to cover both non-housing debt and the mortgage payments, incorporating PITI, principal, interest, tax, and insurance, while capping their back-end debt-to-income ratio at 43%. So assuming a 3% down payment, we try to calculate the maximum affordable housing budget for each individual consumers, and then compare that to the moderate priced home, which is defined as 80% of median home value in the county where they live. And then in the fourth building blocks, we try to apply a simple discount factor to convert the number of consumers who can afford a home to the potential home buyer households. So this is how we identify potential home buyer households. Next, we will examine the trends of potential home buyer households in relation to house prices and mortgage rates. So in this chart, you can see that there are two lines. The yellow line represents the trends of the median maximum affordable housing budget of all consumers who meet the first two building blocks requirement. And this budget is a function of mortgage rates, demographic characteristics, and credit characteristics. But since demographic and credit characteristics tend to remain stable, so this downward trends of the median maximum affordable housing budget is mainly driven by the elevated mortgage rates. And the blue line indicates the trends of the moderate house prices. And you can see that it has been steadily rising since 2021. And while our methodology is actually comparing the maximum affordable housing budget to the moderate house prices at the consumer level, I'm just using this median maximum housing budget for illustration purpose. You can see that before the the rate surged in 2022. Many prime home buying age non-homeowners, they have a housing budget that's way above the moderate house prices, which explains the intense bidding wars we witnessed during that period. But as the house prices and mortgage rate continued to increase, the two lines intersected and eventually diverged. As of October 2024, the moderate house price is 39,000 above the median. The moderate house price is 39,000 above the median maximum affordable housing budget at the national level. So as a result, we are seeing the number of affordable potential homebuyer households has decreased from 9.8 million to 5.8 million between January 2021 and October 2024. And this is marking a 41% decline. This is the national counts, and next we will try to break it down by regions. And how we define the different region is using USDA's Rural-Urban Continuum Code, and we classify all the counties in the US into three categories: metro, non-metro, and completely rural. And this map provides a reference for these three classifications. The metro counties are highlighted in purple here, and includes all the counties within metropolitan statistical area. And the completely rural counties shown in the light green color are those with fewer than 5,000 urban population. And the remaining counties are colored in dark green, and they are non-metro counties, and most of them fall within the micropolitan statistical area. In this table, where you can see like a 5 snapshot illustrating the trends of potential homebuyer households by region. And the first row reflects the overall trends we just saw earlier, where the counts are dropping from 9.8 million to 5.8 million between January 2021 and October 2024. And the next 3 rows provides details on the composition of potential homebuyer counts by region. And we can see that metro counties account for the majority of these potential homebuyer households, followed by non-metro and the completely rural areas. And this is not surprising, as a significant number of population resides in the metro counties. However, when we compare the counts over time, we observe that the decline is not uniform. The decrease is predominantly driven by the metro counties, which experienced a 43% decline. But by contrast, non-metro counties saw a decline of 22%, and completely rural counties experienced a decline of 19%. So as we talked about earlier, these counts are influenced by 2 factors: the maximum affordable housing budget and the moderate house price. So you might think that faster house price growth in the metro counties could explain the sharper decline in the metro counties, but we actually, when we look at the house price data we have access to, we found that the house prices in metro area actually grew a little bit slower compared to the other 2 regions. So in this slide, I'm showing the median maximum affordable housing budget and moderate house price by region as similar to the one that we saw before. So you can see that overall, the dashed line is representing the moderate house price, and the solid line is representing the median maximum affordable housing budget. So you can see that they show a similar trends across region, but they differ in levels. And not surprisingly, metro counties have the highest maximum affordable housing budget and also the highest moderate house price, and rural counties have the lowest for both. But in metro counties, they have a smaller gap between the maximum affordable housing budget and the moderate house price to begin with. So when the house price going up and the interest rate increase, the housing budget start to trend downwards, and the moderate house price going to trend upwards. They intercept each other much earlier in the metro counties. It happens around April 2022. And when we look at the non-metro counties and the completely rural counties, the 2 lines barely cross, or they don't intersect at all. That means the prime home buying age non-homeowners in these 2 areas still have budget that's above the moderate house prices. In this next section, I will break down the data by duty to serve region. So this map highlights the high-needs rural counties based on the 2023 eligibility data published by FHFA. And both high needs and rural are actually identified at the census tract level, but in this map, I converted it to the county level to ensure that we're looking at a consistent group of counties over time. So a county is classified as high needs rural if it contains at least one high needs census tract and one rural census tract. So there are 4 types of high needs counties on this map. Colonials are colored in blue, and the lower Mississippi Delta in purple, middle Appalachia in green, and the persistent poverty counties in orange. It's actually, the finding is consistent with what we have seen before, that we observe overall in the high needs rural counties, we observe a smaller decline in the potential homebuyer households at about 31%, and compared to 42% in other counties. And also within the high needs rural counties, there's also variation. We see the colonial counties experience the largest drop at 46%, and the lower Mississippi Delta had the smallest at just about 9% during the same time period. To summarize, we have seen that the rising rates and house prices make it really challenging for potential first-time home buyers. While many people are being priced out, we still see a significant number of households who can afford a moderate-priced home in their county of residence. And also in rural areas, we see they are being less impacted, regardless of how we explore the rural definition. And this is because many potential homebuyer households in these areas, they still have a housing budget that's above the moderate house prices. However, I also wanted to point out the limitation of our methodology. So our house price data is based on the housing stock instead of listing. So we don't know what houses, the housing stock data is trying to capture the current market house price if the house is going on the market, but we don't know which houses will be on the market. So limited housing supply on this market could prevent these potential homebuyer households to become homeowners. And another unobserved factor is cash reserve. While they may be able to afford the monthly mortgage payment, we don't know whether they have enough fund to afford the down payment and closing cost. So as the market condition continue to evolve, we will try to closely monitor these potential homebuyer households and try to conduct more deeper analysis across different markets. And as you know, that the data in rural areas might be hard to obtain, we remain committed to enhance our methodology and also enhancing our data. And that's the end of my presentation, and I will hand it over to Adam.
Thanks, Jessie, and thanks to Freddie Mac for having me today. My name is Adam Staveski. I'm a principal associate with the Pew Charitable Trust's Housing Policy Initiative. And today I'm here to talk about the challenges that rural home buyers face when they try to get mortgages, especially small mortgages under $150,000. Over the last several years, Pew has studied the unavailability of small mortgages nationwide. And what we've found is that small mortgages are often hard for lenders to make and harder still for borrowers to get. The lack of small mortgages negatively impacts first-time homebuyers, low and moderate income households, and, as I'll demonstrate today, rural Americans seeking to purchase low-cost homes. Before I dive into the meat of my analysis, I want to provide a quick overview of where we're headed today. Pew's research has found that low-cost homes are still regularly bought and sold throughout the United States, but they are especially common in rural areas. However, buyers seeking to purchase low-cost homes often struggle to get a mortgage, which can limit their homeownership opportunities or force them to rely on riskier alternatives. The small mortgage shortage is a national problem, but it is acutely felt by rural Americans who face several unique barriers to financing, including low or missing credit scores, a large stock of non-mortgageable homes, and a declining number of physical bank branches on which many rural borrowers rely. Finally, we find that one federal program, USDA's Section 502 Guarantee Loan Program, has historically been very successful at boosting the small mortgage supply in rural areas. Now to the analysis. This audience knows as well as anybody that there's no singular definition of a rural community. In fact, Harvard's Joint Center for Housing Studies recently released a report that identified 11 different ways that researchers and policymakers define rural. The choice of a definition has a significant impact on the size, population, and housing market activity of rural America. But it's worth noting that the research findings I'm presenting today remain true regardless of which definition we use. So in this analysis, Pew defines rural communities as those outside of metropolitan statistical areas. And that includes about 1,965 counties, which are shaded in orange on the map, which contain about 14% of the nation's population and about 12% of its residential home sales on a year-to-year basis. Now, I want you to hold this map in your head as I flip to the next slide, which shows the share of home sales in each county under $150,000. In the darker blue areas, upwards of 50% of homes sold from 2005 to 2022 were purchased for less than $150,000. In the lighter blue areas, only a handful of homes sold for less than that amount. And keep in mind that all these dollar values are adjusted for inflation using the Zillow Home Value Index. And so what we see here is that low-cost homes are particularly common in the Midwest, in the Great Lakes region, and in parts of the South. And what many of these regions have in common is that they are rural areas. So to quantify this a little bit more, we looked at property records data compiled by Adam Data Solutions. And what we found there was that about 13.8 million low-cost homes were sold nationwide from 2005 to 2022. About 3 million of these homes, or 22%, were sold in rural areas, while the remainder were sold in urban areas. That might not sound like a lot, but remember that rural areas contain just 12% of total home sales and 8% of higher cost home sales over the same period. That means that low-cost homes are overrepresented in rural communities and have an outsized importance to rural Americans seeking to attain homeownership. However, Americans who want to purchase a low-cost home often find themselves unable to get a mortgage. Due to the high fixed costs of originating a mortgage and the limited revenue potential associated with smaller loans, many lenders have scaled back or stopped offering small mortgages entirely. According to the property records data, just 26% of low-cost homes nationwide were purchased with a mortgage from 2004 to 2022, compared with 71% of higher-cost homes. Although some home buyers don't need a mortgage, instead relying on equity built up from a previously purchased home, there's evidence to suggest that many low-cost home buyers want a small mortgage but are unable to get one. For example, 21% of small mortgage applications were denied from 2004 to 2022, compared with just 12% of large mortgage applications. And small mortgage denial rates were even higher in rural areas, where fully 25% of applicants were denied during this period. Because low-cost homes are particularly common in rural areas, and rural mortgage denial rates are particularly high, data shows stark differences in the rates at which urban and rural home buyers use mortgages. As you can see in the graph, just 43% of rural home buyers used a mortgage from 2004 to 2022, compared with 62% of urban home buyers. This financing gap has persisted since 2004, although it has narrowed somewhat in recent years as urban home buyers have increasingly turned to cash purchases in a competitive housing market. To a large extent, this financing gap is the result of nationwide challenges originating small mortgages. However, rural home buyers also face several challenges to financial access because of where they live. For example, research shows that rural Americans often have low or missing credit scores. Papers from the Consumer Financial Protection Bureau found that 37% of consumers in the rural South have credit scores below 600, and 15% are credit invisible, meaning they don't have enough information available to generate a credit score. Credit scoring issues directly limit mortgage access, as data show that rural applicants are much more likely to be denied due to their credit history than urban applicants. Further, rural communities contain a significant number of non-mortgageable homes. Homes in rural areas are more likely to have structural deficiencies that disqualify them from common government-backed mortgage programs. Homes in rural areas are also more likely to have complicated legal statuses, including challenges with heirs' property and manufactured homes titled as personal property, which make mortgage lending difficult or impossible. And finally, research shows that rural Americans often rely on a declining number of physical bank branches. Nearly 10,000 commercial banks have closed or consolidated since the 1980s, leaving many rural communities without a brick-and-mortar financial institution. Although independent mortgage companies have partially filled the gap, Pew's research shows that they often struggle to make small mortgages, and their online-only business model can be difficult for rural consumers who lack broadband internet access. Altogether, these financial challenges mean that many rural homebuyers struggle to get a mortgage, and homebuyers who can't get a mortgage typically face one of three undesirable outcomes. Some pay for their homes using cash, although this is difficult for first-time homebuyers and other low and moderate income households. Others purchase their home using alternative financing, which includes arrangements like land contracts, lease purchase agreements, and seller finance mortgages. Pew has extensively researched these arrangements and found that they are often riskier and costlier than traditional mortgages. However, in Pew's nationally representative survey of alternative financing users, we found that rural Americans are more likely than urban ones to have ever used one of these arrangements. Finally, some would-be homebuyers forego homeownership entirely and compete for a limited stock of rural rental housing. This contributes to higher rent prices, increased renter cost burden, and a dwindling supply of available rental properties. What can policymakers do to mitigate these negative outcomes? One promising approach is better leveraging USDA's Section 502 Guaranteed Loan Program. Pew's analysis finds that Section 502 excels at originating small mortgages to low and moderate income rural homebuyers. From 2018 to 2023, 24% of loans guaranteed through this program were small mortgages. This is a substantially higher rate than what we see among FHA, VA, and conventional loan programs. Part of the reason for USDA's success is that it addresses some of the key financing challenges facing rural homebuyers. For example, Section 502 has flexible credit score requirements that help include some of those who have low or missing credit scores. The program also allows home repairs to be financed, which can help buyers fix up dilapidated properties. And although many lenders choose not to operate in rural areas, USDA's lender certification process is relatively straightforward and makes it easy for lenders to participate in this market. Besides Section 502, policymakers should take additional steps to boost the supply of small mortgages and increase protections for alternative financing users. For example, the GSEs could consider adding loan purchase targets for small mortgages as part of their obligation to serve the rural housing market. Policymakers could also take cues from the Consumer Financial Protection Bureau and from states like Minnesota and Kansas, each of which has taken steps this year to improve protections for land contract homebuyers. Finally, policymakers could work with depositories in rural areas to identify the challenges they face to profitability and identify strategies for overcoming those obstacles. With that, I will conclude my presentation. Thank you for your time and attention, and please reach out if you have any additional questions. And with that, I'll turn it over to Scott.
All right. Thanks, Adam, and thanks to all of our presenters, Peyton, Jessie, and Adam, for their excellent work. So I will be providing a brief discussion of the three great papers that we just saw. I only have a few minutes to discuss them, so a warning that I'll be moving quickly through my slides, and I won't be able to cover any of the papers in full detail. The first paper we saw by Peyton, Whitney, and Alexander Herman looked at the geographic breakdown of house price appreciation in different types of counties. And here, a picture is worth 1,000 words. So if you look at this slide, this graphic shows the increase in the value of a typical home across 5 different types of counties. Note that in the earlier period, the 2017 to 2020 period, home price appreciation was quite similar across all of these different types of counties, around 16 to 18%. It's a very different story for 2020 to 2023. You had acceleration of house price appreciation in all of the county types, but particularly in the least dense areas, the lower density suburbs, the non-metros, and the smaller metros, around 36% in all 3 of those categories, compared to around 20% appreciation in urban counties. So the analysis then extends to December 2023 and finds that there's been a little bit of a partial reversal of these trends with faster growth in the urban and moderate density counties and slower growth in non-metro counties. With that foundation, the authors look at trends in the home value to income ratio and find that the steepest increase, not surprisingly, happened in the previously most affordable counties. And the most striking statistic from this is that by March 2023, you had a home value to income ratio around close to 4, which is similar to where it was in urban areas, urban counties in 2017. So definitely a red flag for affordability. And then, as we saw, the paper also looked at a lot of interesting breakdowns in regional and county level trends. So this paper provided a very interesting breakdown of the different dynamics in different types of counties. And you hear a lot of anecdotes about where people moved in the pandemic and how that affected house prices, but this brought actual data to those anecdotes. So I think that's just a very valuable contribution. And it was a very detailed paper, so there's lots more to say about it. One small comment I have is they're constructing a measure of income across these different county types, and they use a measure that's the same across this whole time period. So that they acknowledge that that's going to exaggerate the changes in the ratio over time as house prices grow, but incomes remain steady. And their interpretation of this that they offer is that this represents the situation for existing homeowners or existing residents, but that is only really true if existing residents' incomes didn't increase over this period of time. And we know, of course, house prices appreciated much faster than incomes increased, but incomes did increase over this period of time as well. And I think it would be plausible to come up with a measure at, even if county level data is sparse because they're aggregating up to these different categories of counties. I think it would be possible to construct a time series for each of these categories that gives you an income measure each month and allows you to come up with a reasonable evolution of the home value to income metric over time. I'll go to the next paper by Jessie Hickly, and this paper uses credit bureau data to identify a universe of potential home buyers, people who are not currently homeowners but have the appropriate financial qualifications. And then it looks at the home price that these people, these individuals could actually afford, and compares it to the moderate home price in each county, which is defined as 80% of the median value using Freddie Mac's Home Value Explorer data, and looks at the trends in the number of people that could afford a median value home, and finds that it's really decreased substantially from 2021 to 2024. And also that in percentage terms, the decline in non-metro or rural areas has been lesser than compared to metro counties. So this is just a really interesting, this paper is a fascinating use of really rich data on debt obligations, income, location. They just have a lot of great stuff in there that you could do a lot of interesting research with, and this is a great use of that data. So one thing that I think we saw in the previous paper is that smaller metros and the less dense parts of metro areas kind of might behave similarly to non-metro areas. So this paper uses a breakdown between completely rural, non-metro and metro areas, and I think it would be interesting to just break down that metro category a little bit to see if there's different dynamics in the smaller versus the larger metros. And I want to know more about the potential home buyer universe. I think it's just a really interesting amount of data that's out there, and I'd want to know, for instance, like how many of these borrowers or these potential borrowers are actually converting into home buyers each year, and what has been like the percentage over time of this population of borrowers that have been able to afford a moderately priced home. Finally, I'll talk about the third paper on small mortgages by Staveski. This paper looked at some of the barriers to credit access for rural borrowers who might benefit most from small mortgages, and some of the interesting highlights: 26% of originations of small mortgages were originated in rural areas. So I thought that was really interesting, and only 47% of rural home buyers used a mortgage to buy their home. So that seemed very low, and you had higher denial rates for small mortgages. The same size of mortgages, you had higher denial rates in rural areas versus urban areas. So a bunch of interesting results, and the paper recommends expanding the USDA Section 502 loan program and other similar programs. So this paper provided some very interesting insights into barriers to credit access for rural borrowers, and some of the things you might expect, like lower credit scores for lower incomes, but some things that you may not have expected, like deficiencies in structural deficiencies in homes, the difficulty of appraising homes, and lesser access to broadband internet. I'd be interested to see more detail on the USDA 502 loan program. It's talked about quite a bit in the paper, but I think I'd like to just understand a bit more about how it works. I would just be interested in seeing more detail on that. You talked a bit about alternative funding mechanisms that borrowers use, and that they might be riskier or in some ways, not preferred for borrowers. And I'm curious about why those are, not as good for borrowers as a standard mortgage, or if they actually could be a good option for some borrowers. There's also not much discussion of the cost of lending, and I think this is what we hear most often from lenders, is that these smaller mortgages are costly to originate and less profitable. And so I would be interested in, just like as an expansion, just digging into that and really kind of interrogating that idea and digging in if there's any data available on it, trying to understand, is this a real problem on the lender side, and if so, what solutions might be appropriate. So I'll save my general discussion for just after this, but I just want to plug, as I wrap up here, a few things that are of potential interest. One is, if you're interested in the topics that we talked about today, or any other range of topics related to housing, the FHFA will have a Spring Econ Summit in May of 2025. I'm one of the organizers for that summit, and there's a call for papers out now. So if you have related research, we'd be very interested to see it. And finally, I also want to highlight that FHFA releases public use data. It's loan level mortgage data, and it includes a rural flag. So we could potentially see some interesting analysis come out of that. So with that, that's my time, and thanks to everyone for your presentations. So now I'll open it up for some discussion. All right, welcome back, everyone. Thank you for your presentations again. Okay, so I just have some questions that I think tap the common themes from some of these papers. One thing I think that came out in all of the papers is, the affordability challenges that have emerged in rural areas in recent years. And I think I would like to understand a little bit better, if anyone has some insight on this, how has this actually affected rural residents? Have we seen, for example, like more housing insecurity or lower home ownership rates in rural areas as house prices have increased. Because you could also imagine that rural residents who were previously disproportionately already homeowners might have really benefited from appreciating house prices. So I think I see Peyton nodding. So do you want to speak to this first?
Sure. Thank you, Scott. Yeah, I think that was also something maybe you had added on the discussion slide after my paper. And I totally agree that existing home buyers who had their properties before the pandemic boom in home prices definitely would have benefited from increasing home values. So we are predicting and positing that first-time home buyers, people who are they're just up against such higher prices now, and so that it's making it exceptionally difficult for them to enter the market. And we've also seen, not specifically about rural residents, but across the whole country, we've seen cost burdens increasingly climbing the income scale. So housing is taking up a higher and higher share of people's incomes, even at moderate income levels. So that makes it more difficult to save for a down payment, and there's a lot of factors making it difficult to enter the home buying market now, and I imagine that extends into rural areas very much so.
Yeah, totally agree with everything that Peyton just said. I think one thing that I would want to note is that in rural areas, we know that the home ownership rate is actually higher than in urban areas, and so I think that kind of speaks to the centrality of being able to buy a home. It's so important to be able to buy your home because of the shortage of rental housing. I read a report from the Urban Institute recently that found that 102 of the 152 counties with the most severe shortage of rental housing were located in rural areas. And so, if you can't get access to a small mortgage, if home prices are rising disproportionately relative to other parts of the country, it makes it all that much more harder to remain stably housed.
Absolutely.
Yeah. And my potential home buyer research is actually showing that in rural areas, those potential home buyers are doing relatively better compared to the metro counties. But as I mentioned, that the limitation is we don't know if they have enough cash for the down payments to afford a house. That's another piece of the affordability, and especially with the high inflation we experienced and the cost of living is being so high, it could be very challenging to save for homes.
So I think what I'm taking from all of your answers is that this is a big concern, particularly for first-time home buyers, and maybe less so for people who already owned their home before the pandemic. And I think that it would be fair to say that across the country, it's become more and more difficult to be a first-time home buyer. And that it's not specifically a rural phenomenon. But I'm wondering if anyone has reasons to think that we should be particularly concerned about the difficulty of being a first-time home buyer in a rural area.
Well, one thing I would say is that, I know that since the pandemic, people have been increasingly moving to rural areas. And, having the flexibility to live and work wherever you'd like, gives people the option to move to rural areas. And so I know that I think it's about 600,000 people have moved to rural areas since the start of the pandemic. And, many of these are first-time home buyers looking to get that first rung of the homeownership ladder. And so I think that, to the extent that people, younger people are able to live and work wherever they'd like, I think rural areas are one place where they can make that happen.
So that sounds like, at least for those borrowers, that could be a really good thing. The ability to, sort of do what I've seen called housing arbitrage, and, move into more affordable rural areas, get on that first rung of the ladder, make their first time home purchase, and continue to be able to work in jobs that may not have previously been available in rural areas. So could this be kind of a win-win that people are able to move to rural areas and maybe even rural areas could benefit from the increased demand for local goods from people moving in, or is it really mostly a strain on rural communities?
Yeah, I think for potential first-time home buyers in rural communities, or even for existing homeowners who look to move up, with all these people coming from other places with higher budget, it could also put affordability constraint for those existing residents.
Mm-hmm.
Yeah, I would say that it's not. I think this needs to be researched more, of course, in more detail into these specific communities where we have seen really high home price appreciation, which is, as I explained, that's what we're looking to do, hopefully, for the next couple of months. So I think there will be advantages, of course, for people who are able to move to these areas, and there likely will be adverse outcomes for existing residents who already had, relatively lower incomes than people in more urbanized spaces. And we should keep in mind that it's theoretically going to be a specific subset of people who are able to take advantage of these relatively lower cost places, right, and take advantage of remote work opportunities. I'm thinking there'll likely be, higher income, certain types of job duties, et cetera, et cetera. But that's something we want to look into more.
So I think a few of you mentioned manufactured housing. So I'd be interested in hearing anyone's thoughts on the role of manufactured housing in expanding rural home ownership.
I think manufactured housing could be a great solution for the housing supply in the rural area, as it has relatively low cost and seems to gain more traction in the rural markets recently.
Yeah, I would echo that. I mean, Pew certainly is of the opinion that manufactured housing is a critical component of filling the nation's supply shortage. And I think that the challenge with manufactured housing is, we know that they're high quality homes, we know that they're affordable homes, but the challenge is often getting financing for buyers to actually get those homes. If you look at the denial rate data using the Home Mortgage Disclosure Act, you see that manufactured home loans are denied at genuinely astonishing rates. And the challenges are even worse for those who don't own their homes as real estate and who instead own them as personal property. Getting a personal property loan is particularly challenging, and there's a severe lack of lenders who even operate in that space, and the terms and the interest rates are much higher than traditional mortgages. So I think the federal government definitely has a role to play to support that market a little bit better, and make sure that folks who want manufactured homes can actually get them.
All right. I think I just have one more question here, which is, we've talked about some of the barriers to credit access, particularly in rural areas. I think, Adam, you spoke about this the most. I guess one thought that I had, just my economist brain drawing supply and demand curves, started thinking, if we were able to expand access to credit for rural borrowers, could it exacerbate some of these affordability concerns that we're talking about? Especially if it's not matched with an increasing supply, are you going to potentially just drive up prices more?
Yeah, I certainly think that that's a fair concern. As you note, if you're basically expanding access to credit, you're kind of juicing demand for housing in rural areas. But at the end of the day, I think that we should be supporting people who want to live in these areas, and hopefully the increase in demand would generate a supply response from developers, and we could grow these communities and have enough affordable housing for everyone.
All right. Well, I think that's a great place to leave it. So thanks again to everyone for presenting today, and thank you to all our attendees for joining us for today's session. Have a great rest of your day.